All right, it is time now. Okay, here we are. So it's time now for our Financial 15. If you're just joining us for this portion of the webinar, you can, if you haven't already, hit the like, subscribe, and notification buttons so that you never miss an opportunity to see a new video that comes out or to even chat with us during the live videos. In our Financial 15 today, we're going to talk about the ability to choose your retirement tax rate. I often use this analogy. During the pandemic, I was driving an F-150 pickup truck. I still drive one today, but this was a different one. And I was at Costco getting gas. So I get my gas from Costco because it's cheaper. And I'm leaning up against the truck, pumping it in. And at the time, I was paying $1.85 a gallon. So I don't know where you're hearing this from, but $1.85 a gallon is much less than what gas rates are today. Gas prices. So gas prices are, somewhere around $4, and if you're in California, it can be much higher than that. But I remember thinking to myself, if I could buy all the gas that I'm ever going to use during my lifetime at $1.85 a gallon, I would do it right now. Give me that contract. I would sign up for it. Forget about storage, spoilage, all that stuff. I understand that. But fundamentally, I'm thinking, well, at the time I had oil heat in the house. Geez, check that one off. I'll buy all that now. And let me be able to fill up my gas tanks for the rest of my life. I would have signed up for that. Folks, that is the situation we have right now with our tax rates. We are pumping gas at $1.85 a gallon for our tax rates. We're in the lowest tax rates that we're ever going to see during our lifetime. Certainly. I know people say, and many of you heard this already, that whether you're in the class or the YouTube webinars, you've been told year over year, maybe 30, 40 years of your planning experience, that you're going to be in a lower tax rate in your retirement. No, I really haven't met that person yet. So even if taxes somehow magically were to stay the same, you're likely to be in a very similar tax bracket. But the reality is that tax rates have to increase dramatically in the future, probably by about 2030, and we're going to talk about that in a moment. But in addition to that, you have things that you want to do during your retirement. And then you've got the government at a certain point who's going to tell you exactly how much you have to take out of your retirement plan, out of your IRAs. These are called required minimum distributions, and you can't say no, because if you don't take them, you're penalized up to 25% of what you should have taken. And you might think that that's a lot, 25% of what you should have taken, but it used to be 50%. The penalty used to be 50% of what you should have taken from your required minimum distribution or from your IRA in the form of required minimum distribution. So the IRS is even giving us a break on that. Aren't they great? Well, we know that taxes have to be much higher in the future. But first, we're going to look at current tax rates. So let me get my pen here. And I'm going to reposition my whiteboard while we're talking. And we're going to talk about current tax rates. So follow along, folks. Here we go. All right, I'm gonna draw on this whiteboard. Now let's look at, these are tax rates as we are today. You folks that are on here every week have seen this chart 100 times. You probably have it already, and if you don't, you can go to attleborowealth.com and you can go to the resources section, drop down to where it says the slot corner. Right? Resources, slot corner. You scroll down and you can download this chart I'm sharing with you. No cost. You put in your email address and you'll be able to pull that down. So here are our current tax rates here. Everybody can see that, right? So it starts at 10, goes to 12, 22, 24, 32, 35, 37%. The important thing to note here is not only just the marginal tax rates. Most of middle-class America lives right about here, 22 and 24. Married filing jointly and single filers. This is risk number one when we're talking about tax rate risk. Tax rate risk means taxes being higher in the future. If you go into retirement as a married couple, you're not going to be there forever. One of you is going to pass away before the other. That is reality. If you haven't considered that already, it's time to. And many people don't. We know statistically that the older we get, the likelihood of both spouses passing at the same time is It gets greatly diminished, almost to nothing. But you don't think about it when you think about financial planning, tax planning, and relation to finances. But what happens when you're suddenly single? Your spouse passes away. Well, you suddenly get into this single filer category. So even if taxes miraculously stayed the same, your threshold for the top of the 22% bracket, for example, goes from $201,000. Right? You can have taxable income up to the top of the 22% bracket at $201,000. It drops all the way down to $100,000. Or if you want to just focus on the 12% tax rate, well, you can earn up to $94,300 for 2024 for taxable income as a married filing jointly taxpayers. But as soon as one of you passes away, that drops down all the way to $47,150. So just by losing your partner during your retirement, your taxes are likely to increase dramatically, because where you would be paying taxes at 12%, you can see just earning $50,000 a year brings you up as a single filer into 22%. So that sounds bad enough, right? So we've got that risk. That's tax rate risk number one. One of you is not going to be here forever, but one of you is going to pass before the other. Tax rate risk number two is we've got a lot of pressure from the federal government. So we're going to talk about some of those. So follow me over here. So we've got a couple things. So we talked about this a few weeks ago, but this is the Social Security and Medicare Trustees report. So this comes out periodically, and this came out just a few weeks ago. And that report told us that Social Security runs out of money. Let me get a different pen color here. I'll make it red. It runs out of money in 2033. Medicare runs out of money in 2036. So these shortfalls, so what does that mean? The trust funds are depleted. The trust funds are depleted, and then only a certain percentage of benefits can be paid. So that's a 21% cut in Social Security benefits and 11% cut in Medicare benefits. That's going to affect 70 million people for Social Security and 82 million people for Medicare. Nobody's accepting these pay cuts or benefit cuts. Nobody's accepting that. So something has to be done to fix this problem. Now, it should be done now, but there's no courage in Washington to change these things now. So it's probably going to get kicked down the road for a long period of time. And that's probably going to be early 2030 or so. 2030, 32, 33. It really all depends on the continuing data that comes in. Now, let's add to it. National debt. So this is a snapshot that I took just a few minutes before the webinar today, because this clock here, you can see this at the usdebtclock.org. These numbers move so quickly that you can't even keep up with it. So I just took a snapshot to share with you folks, but that's $34 trillion, almost $35 trillion. And the last calculation I saw was that we spend this year we'll spend about $870 billion in interest. And the reason that is first of all, this is a huge number, right? $34 trillion is a huge number, and it's just compounding on top of itself because we can't manage our finances well as a nation. And it's not a political statement. It's both parties. Both parties, everybody involved is doing a terrible job when it comes to financial management. So we got $870 billion of interest to pay. And that is because, not just because the national debt has increased and continues to increase, but because the interest rates have increased so much. So we went from very low interest rates for a long period of time, and the debt kept clicking, but the interest on the debt wasn't bad, and now we're averaging more towards normal. So we're going to start really feeling the debt, and in fact, we're already feeling that. So knowing all of that, I look at it this way, and this is not my chart. I stole this chart with permission from my friend David McKnight, because I saw it as part of his presentation, back in 2016 at one of my EdSlot training events, and I really liked it because it made sense to me. But it looks like this. If we go at 2024, these are revenues coming into the federal government, and revenue equals tax. And if we're, again, here at 2024, these are expenses that we have to pay. And we're talking specifically about Social Security, Medicare, and interest on the national debt. So we're just going to say interest, INT for interest. Now we know if we go back over here, I'm just going to capture two dates. I'm going to take 2033 and 2036, and let's put them on the plot here. And let's give them some grace here. We're going to put 2033 here, and we're going to put 2036 here. So what you're seeing is maybe they should be up here. It's the same timeline, but we'll put them up here on this curve. So whether it's revenues or whether it's expenses, they're on the same timeline. But you have revenues declining. Why are revenues declining? Well, because we've got this huge flux of baby boomers who are coming into retirement, and that's a significant amount of people who are paying not payroll taxes. And there might be a gap in the time that they're paying from when they're paying payroll taxes or and not have to pay their required minimum RMD tax. So we've got projected decreases in revenue and higher expenses just in the form of Social Security, Medicare, and interest on the national debt. So at some point, there has to be a point of no return. And we think that that's probably around 2030. And we've done studies and we've looked at studies. And if we know that the existing tax rates look like this, I just shared them with you a minute ago. Let's start at 10, 12, 22, 24, 32, 35, and 37. I made an extra one. Let me make sure I got them all. 10, 12, 22, 24, 32, 35, and 37. Yes. So there are current tax rates under the Tax Cuts and Jobs Act. So these rates are set to expire 12/31/2025. 2025 is going to be a huge tax reform year, probably. I don't know what it's going to look like, but here's what has to happen. We should be thinking about, okay, we've got a problem coming down here. We can't cut benefits for Social Security. We've got, what was the number there? 70 million people who will or are receiving their Social Security benefits. They're not going to take a 21% cut in their Social Security pay. We've got an 11% shortfall in Medicare for 82 million people. That's not going to be accepted by the people who are expecting their Medicare benefits. So something has to happen. And we think that something that has to happen is about 2030. But the problem is, should it be starting to happen now in 2024? Responsibly, it should be. But Washington has no courage. So what they're likely to do is continue to kick the can down the road. And let me comment on what I just said about Washington has no courage. Washington has no courage because we don't allow them to have courage. Anytime a legislator stands up and says, I'm going to make changes, I'm proposing changes to Social Security, all folks hear is they're going to take away my Social Security, and that person is likely not to be elected. So the only way that this can work is that if both sides come hand in hand to the table in front of the TV cameras and say, we're working on this together and we pledge not to kill each other over it, but politically kill each other over it. So I don't know. I don't see that happening anytime soon. So that will probably be pushed until the 12th hour. Now, it's easy to say, well, they're going to wait till the 11th hour, but let's say that, history has shown us in recent years that whether it's debt ceilings, whether it's other financial disasters really in front of us, that they wait till the last minute to extend debt ceilings, to make any changes, to pass budgets. So it's likely, knowing that we're probably going to be about 2030 before we see any significant tax reforms or tax increases. So what does that mean? That means that we still have time and tools and resources to take advantage and lock in these existing tax rates. Well, maybe not 32. Let's go back. 22 and 24. This is where most of middle-class America lives. Right around that 22, maybe. I think the average effective tax rate for most middle-class America is about 18%. Our studies show that 18%, when we see the tax increases, when we fund these revenues enough to fund what we need to when we increase revenues. Let me say that the correct way. When we get to the point where we're increasing revenues enough to fund what we need to, what we've pledged to, not all the extras, just paying the credit card bill, basically the national credit card bill. The studies show us, and our studies show, that your average middle-class American is going to be in the 40 to 50% effective tax rate. So instead of 18%, you jump to 40%. Instead of 20% or 24%, you jump to 50%. That is the real future of our tax burden. So if you think about it, go back to the pandemic. Go back to 2020. Go back to pumping gas into your truck at $1.85 a gallon, knowing what you knew today. If you're able to lock in those rates or lock in those prices at $1.85 a gallon instead of paying $4 or plus today a gallon, wouldn't you do that? Well, you have the ability to do that. You have the ability, the tools and resources to do that through things called Roth conversions.